All right, I'm just going to show you the solutions to the previous classwork. It's based on what we have done. It just brings everything together, okay? And it's pretty much similar to the example we did earlier on. Please check them out and mark. All right, you can try these ones as well. And for now, I'm just going to move to what we call simple interest and hire purchase loans. As an individual, you may borrow money from the bank, and that is to take a loan with the bank. The original amount of the loan borrowed is called the capital amount. The loan will attract interest at a constant amount. Okay, the interest amount will be given as a percentage, but that percentage will be an annual amount, annual percentage, meaning that it will be a percentage for the whole year, 12 months, that is. Interest will add up and accumulate over a number of years. So it will increase the original amount of the loan. So it'll increase what you actually owe. That's what interest will do. It'll increase what you actually owe. So it's bad to buy on credit. Please note that under the simple interest formula, interest will be the same amount. It will be the same amount every year. And as I've said, the disadvantage of buying things or taking a loan, the first disadvantage is that that loan will attract what we call interest. It will attract interest, and interest will result in you having to pay more than what you took. And this is the simple interest formula we are going to use. Okay, this is the formula we are going to use. And I'll break down what each variable or alphabet or letter stands for. A, excuse me. A here will represent the accumulated amount after adding interest. P is the principal amount or the original loan amount, and I is your annual interest rate, and N will be the loan period. And when you want to calculate interest, you'll have to use this formula. Interest is the interest amount. The big I or capital I is the interest amount. P is the principal amount or original amount, and N is the loan period. And the small I will be what we call the annual interest rate. Now let's look at this example here. Troy took a loan of 100,000 Rand with Lit Loans Limited. Interest is calculated at 11% simple interest. We need to calculate how much Troy will owe after 5 years and also calculate interest charged over 5 years. So when we calculate how much Troy will owe after 5 years, we are looking for A there. We will use this formula because it told you that interest is on simple interest. Here we are required to calculate the value of A. We do have the principal amount or the original amount of the loan, which is 100,000. And we do have I, which is your interest rate of 11% and will be 5 years, which is the period of the loan. So when we substitute this into the straight line or simple interest formula, where there's P, we will substitute 100,000. Where there's I, we substitute 11%, where there's n, we substitute 5, which is a period of 5 years. And when you put this into your calculator, it will give you 155,000, which is the value of A. Troy, after 5 years, will be owing 155,000. Okay. And B wants us to calculate interest charged over 5 years. You can use this formula where P stands will be substituted with 100,000, I will be substituted with 11%, and N will be substituted with 5. And that'll give you 55,000. Or you can use this formula where your interest amount will be your accumulated amount minus your principal. So your accumulated amount of the loan over 5 years was 155,000 and the principal was 100,000. The difference between the two will be 55,000 rand. Okay, try this classwork quickly. And check out the next video for solutions. Ke a leboha. Kgotso.